I'm Ian Castle, founder of Microcap Club, home to the best microcap stock pickers on the planet. Since 2011, our members have profiled over 1,300 microcap companies, with over 290 turning into multi-baggers. That's more than one big winner every single month for 14 years. If you share the passion for finding great companies early, before Wall Street and the institutions, Microcap Club is where you belong. Join us.
All right. Welcome everyone to our 29th business breakdowns with Hydreight Technologies. Before we get started, I want to remind all participants the purpose of this presentation is for informational and educational purposes only and should not be construed as a recommendation to purchase or sell any security. Microcap Club is not a registered investment advisor. Microcap Club, its partners, members, subscribers, and affiliates may or may not hold positions in one or more of the securities mentioned on this program and may trade in such securities at any time. Do your own due diligence and seek counsel from a registered investment advisor before trading in any security. I want to thank the Microcap Club community for tuning into this business breakdowns conversations with Hydreight Technologies CEO Shane Madden and Victory Capital CFO Chaffin Diamond. Shane and Chaffin, welcome. Thanks for joining us today.
Thank you, Adam.
Thanks, Adam.
My tag team partner for this business breakdowns is Charles Hutchison. Charles is an attorney and private investor and has been a Microcap Club member since 2020. Thanks for joining us, Charles.
Thank you, Adam.
The business we're breaking down today is Hydreight Technologies, which trades on the TSX Venture Exchange under the symbol NURS, NURS.V, and also over the counter under the ticker HYDTF. Hydreight was originally profiled in May by Real Liger Cub. Hydreight Technologies is a 50-state mobile health care and telemedicine company and one of the fastest growing in North America. Hydreight has grown rapidly from 1 million in adjusted revenue in 2020 to over 22 million during 2024, exclusively through its nurse network and white label solutions verticals. They have already onboarded 3,000 plus nurses with significant improvement in new business partner signups expected going forward. Beyond the legacy verticals, Nurse's newly launched D2C direct-to-consumer VSD H1 platform is expected to geometrically scale recurring revenues beginning in Q3 of this year. Already ahead of schedule, the platform has sold 400 plus licenses, targeting 1,000 by year end. Existing partners are already generating more than 100,000 monthly orders, with the pipeline being big enough to hit 1.3 million full year order target, even before factoring in the expanding catalog of recurring medications. Hydreight now holds its strongest cash position in history and is fully funded to pursue the strategy moving forward. So with that introduction, before we get into the presentation, Shane, I'd just love to hear more about your background, and can you tell us what brought you to Hydreight and what was attractive about the opportunity?
Yeah. Hi, everybody. Thanks, Adam, for the introduction. My background is a lifelong entrepreneur. I guess my educational background is based around electronic engineering and business. Had a very early start into the business world. Around 20 years of age, had a number of exits in the private sector, had a tremendous interest in the kind of software space, even throughout the early 2000s into 2010. I eventually ended up moving to Las Vegas in 2012, mainly due to my wife, and essentially found some emerging markets. Was involved in kind of the early days of the point of sale for the marijuana industry. Basically anything that was kind of an emerging market or took my interest was of interest to me. Within that journey, the mobile health and wellness space, kind of the overall infrastructure, I guess, of the United States healthcare system intrigued me. Coming from a very different healthcare space in Ireland. Obviously, Canada, Ireland would be similar in terms of their structure from a healthcare space. One of my partners in one of my endeavors over here in the US would have been a surgeon who is now a board member on Hydreight, Jeremy Roebuck. Went into an extensive proof of concept on the overall healthcare space. Obviously, it's incredibly complex with 50 states, and saw a huge opportunity. The healthcare industry gets broad stroked into being broken and fragmented and those kinds of buzzwords, but it was a real mess. Very reactive, there was no apparent businesses that were trying to actually get ahead of the problem, see where the industry was going. And that's kind of where Hydreight started. We started off by identifying the directions we were going to go, where we saw the healthcare industry going. The opportunity, of course, because of the size of the industry, was so large that it kind of, we almost had to do it. So obviously we've been on a 7-year journey here, incredibly difficult task of putting together what I'm about to go into, but I'm happy to see that obviously shone a light on an endeavor and an initiative like this, such as COVID and the Ozempic craze and things like that. But yeah, I think as we flesh out what this business is about, we'll see that we're definitely in the right position to correctly.
Excellent. A lot of interesting stuff there that we can dig into further. Thanks for sharing. With that, I will turn the call over to you, Shane, to go through the presentation. As a reminder for listeners, if you have questions, please click on the Q&A box at the bottom of the screen to submit them for the audience Q&A. And Shane, the floor is yours, and I will thumb through the presentation for you. Just let me know when you'd like to move forward.
Thank you. Thank you. Actually, I think for any of the new listeners here, I think it's probably easier to start with the fourth slide there, which is our end-to-end solution. Adam, if that's okay, if you could. It's unusual that I have to get you to control, but let me know if you can move to there. There you go. Perfect. Okay. So again, kind of what I had kind of given an oversight to is the foundation of Hydreight Technologies was the vision that there was only 3 ways that this healthcare system was going to kind of transcend into: the downstream problems, the reactive nature of the system itself, from get sick, see a physician, go to the hospital, and then obviously all the downstream issues from there. Very, very difficult thing from a holistic fashion to view. So we saw that there was going to be 3 areas that this would go. Mobile health and wellness, which is essentially being able to bring healthcare to somebody in a remote setting. So that was our first vertical, the nurses. The second vertical was around the bricks and mortars, the non-traditional doctor's office. So anyone who is providing true healthcare has to comply with medical board laws, has to comply with pharmacy board laws and nursing board laws, because they're providing true healthcare, but they're not your traditional doctor's office. Obviously, anyone in the US has seen that the explosion of that since 2018, since we formed. There's about 200,000 bricks and mortars that would fall into that category right now and growing rapidly. And the third vertical, again, from our expansive view of where we saw the industry going, was the direct-to-consumer, self-administered, health and wellness, preventative healthcare, longevity model. So that has been, of course, kind of glamorized, I guess, by the Ozempic and Mounjaro and things like that. But that's mainly one product, and we'll get into it a little bit later. So that was a kind of the vision. We saw that was the 3 verticals that the healthcare space was going to go, and any solution to the downstream issues were going to come from a combination of those verticals: preventative, individualized healthcare, which again I'll go into in a little bit as to what we've structured. So to do that, we had to create a 50-state medical company. We had a proof of concept of all 50 states. 3 boards. In many cases, this was ahead of legislation. So we were working with boards on a continuous basis to provide best in practice while they were figuring out legislation. In some cases, I know that sounds unbelievable, but some businesses are essentially ahead of legislation in many cases. So we started with our nurses. We got essentially called the Uber for nurses for that vertical, mainly around the independent contractor kind of mantra. So we were the first company that allowed nurses to monetize their nurses license essentially outside of a bricks and mortar. So same compliance as working medical director, physician network to see the patients, and they're providing the actual healthcare service, but they're able to monetize it. All of our verticals were based around not only what direction was the healthcare industry going, but it was based around a very different strategy, which was B2B2C. We wanted to be an ecosystem for healthcare. I think the Financial Times called us the Shopify for healthcare. We wouldn't really subscribe to that, because that kind of gives it just a software connotation, where in actual fact we like to think of ourselves as an ecosystem or the marketplace. So we're a 50-state medical company at our core. We have layered on top of that medical direction in all 50 states. Each state has 3 boards, the nursing, medical, and pharmacy board, which again, in each of the 3 verticals that I talked about, mobile, bricks and mortar, and direct to consumer, can be very, very different. So offering that in a cohesive fashion. And then the underlying factor of it all is corporate practice of medicine in the United States makes what we've built here not a nice to have in many cases, but a must have. Corporate practice of medicine is exactly what it sounds like. It's the prohibition of medicine by a corporation. So unless you have a very unique structure. And again, so our moat in all of these cases, and our goal was to be an ecosystem, a place where business is done. We solve real world problems from a compliance standpoint, from an operational standpoint, and then of course we use technology to be the connective tissue to the customer. So B to B to C. We don't like to think we're anybody's competitor. In actual fact, we can be everybody's partner if it is viewed that way. So our first vertical, again, is based around the nurses. We have over 3,000 nurses. They pay a subscription just to be part of the medical network, again, because the earning potential is so high. They act as independent contractors of our 50-state medical company, depending on the state, and they offer services in a remote setting, a home, a hospital, or wherever it needs to be given, under complete compliance. So that side of things is incredibly exciting. It was our first go-to market. We focus mainly on RNs because they can, give most of the services in most states. So our second vertical, then again, in the overall view of Hydreight, was to create a bricks and mortar solution. So again, med spas, health and wellness facilities who are offering true healthcare have to comply with state laws. Again, we offer anything from a compliance solution to medical direction to physician network to tech. Pharmacy network, of course, is layered on top of that, which is incredibly complex in the US. And then our third vertical, again, on the same mantra of B2B, partnering with businesses to solve real world problems, was our third vertical. That was released this year. Migration process, got it. First signs of revenue was at the end of Q2, Q3, and Q4. Obviously, very exciting based off of its model. So, kind of in terms of overall view, just to give a kind of a snapshot, a healthcare ecosystem that's aimed at 3 very specific areas of the healthcare industry. It's a $5.9 trillion market, of which 90% of it is technically preventable because it falls under chronic care management. There has been no business that has attempted to kind of attack it that way or address it that way. Your diabetes, your weight loss, things that we'll get into shortly, the downstream effects of lifestyle, all of these things would fall under chronic care management and would fall under the addressable market here. Things that have happened outside of our control that have shone a light on the company would have been obviously COVID, shone a need on the need for accessible healthcare. The Ozempic kind of glamorization and the GLP-1 side of things shone a light on the direct-to-consumer self-administered model that it exists. Again, some of these things to people who were savvy in the industry were not new, but there has never been a home for that business. So there's many businesses out there that are kind of one of the layers. I mean, you have your telemedicine companies and you have your people that sell GLP-1 for themselves with their own company. That was not our model. Our model was, why can't we be the ecosystem, leverage our 50-state infrastructure, leverage our doctor network, leverage our pharmacy network, and then connect in a B2B way, so it's far more scalable. So the third vertical, again, I'll pause in a second and talk about a few other things, but our third vertical is incredibly exciting from a scalable nature because, again, those medications on that vertical are recurring medications. So you have your GLP-1s, your peptides, the sensitive nature stuff, the ED, the hair loss, testosterone replacement, HRT, at-home testing. Things like that are self-administered. It's virtual care sent to the home. We didn't want to be another runner in that space. We wanted to be the place where all the business was done. So there was a lot of businesses that opened up during COVID. So this would be one category of customer. I'll go into the other two in a second, and I'm focusing on the third vertical because of the scalable nature of the model, and the impact it's had on the company, and the impact it will continue to have from a revenue generation perspective. So a lot of businesses opened up during very relaxed laws, whether they were telemedicine laws or whether they were fundamental corporate practice of medicine laws, which means that the business shouldn't really be operating like that. Um, when the laws were relaxed, these businesses had already got traction in certain services, and they were doing extremely well, making a lot of money, and they would have to go back to the drawing board, restructure themselves either for one state, not be able to expand, or a myriad of problems. Then you have the second category of customer who is structured reasonably okay for their one state, or for their one product, but they can't expand into other states, they can't expand into other products because they're not just they're not a medical company. They never had the vision of structuring them. State laws, they don't look at legislations that are 12 months down the line. They didn't have that vision. So we can be a home for all of those. And then you have the third vertical, which is basically businesses who have a lot of customers that are a perfect profile for this type of product. You have your gym networks, supplement companies, and peripheral companies in that kind of peripheral healthcare space. But again, they're not structured as a healthcare company. So we're a perfect plug and play for them to be able to monetize that customer through basically partnering with a medical company, increasing the LTV of their customer. So kind of that's the vision of Hydreight. Obviously very expansive. Just to give a snapshot on how we've done, we launched with our nurses in 2018 was the founding of the company, but 2019 was really the first time we started actually generating revenue. Obviously we've gone from there to the bricks and mortar, the second vertical, approximately 2020, and our third vertical, 2021, pretty much with the bricks and mortar, and then 2023, Q4 was kind of when we soft launched, started onboarding customers onto our third vertical, and Q2 and very end of Q2, almost Q3 of this year was when we first started seeing some revenue to the balance sheets of that third vertical. That essentially kind of completed the vision for Hydreight as addressing the addressable market as we've seen the healthcare industry going. So I know we focused on one slide. It's not your traditional kind of deck walkthrough, but I think we can go into a lot of different rabbit holes here and circle back on how the company is doing through some in-depth questions.
All right, great. Thanks a lot. That was great. I'm going to stop sharing my screen. We'll dive into some questions now, starting with me, and I'll pass it along to Charles in a few minutes, and then we can get to questions from the audience. Again, as a reminder, as an audience member, if you have a question, click on the Q&A box at the bottom of the screen to submit. Okay, great. Well, you covered a lot there. I think our members and investors are also familiar with what you said in Toronto just a few weeks ago. One of the things I wanted to harp on that I think is interesting about your business is you have your hand in a lot of fires, and it maybe can be difficult to focus. You have a lot on your plate right now. How do you prioritize what's most important, and what do you think are the most kind of important strategic levers for the business moving forward?
Yeah, wonderful question to start off with, Adam. I think we've been in a unique position for a while in that most businesses, I think, struggle with the direction. They might give the illusion of direction. They might give the illusion that they know exactly where they're going, but they don't. This has always been the vision for Hydreight. So we've been structuring our company, our departments, with these three verticals in mind for quite a while. Still to this day, the biggest single spend every month is legal, because we watch the legislations. We put things in place where we're aware of things 12 months in advance across 3 boards across 50 states. Our moat is compliance, and this is one of the things I kind of really hammer home. We're not a nice to have. The businesses that get this, whether it's the nursing, the bricks and mortars, or the third vertical, we're a must-have in some cases. Or you go figure it out yourself at tremendous cost, but it's going to take you so long to do those things and so costly that you'll be there. So where our focus comes from, getting back to the question, is that we have had the sort of advantage of knowing exactly what we're releasing, how we're releasing it, when we're releasing it. Now, from an impact perspective, of course, the third vertical, from a scalable nature, is obviously a lot of our focus for the next 12 months. Our other two verticals, because they were previous, we have accelerators coming for them, but they take less effort essentially than the third vertical. So we've had that kind of vision. We've been structuring the company accordingly to be ready for the growth, to be ready for what we need to do on that third vertical. And we've been finding it relatively easy. I won't say anything is easy in business, but we find it relatively easy to focus and kind of plan and structure our company accordingly.
All right, excellent. Thank you. And then how about, just kind of snowballing off of that, my initial question, how about on the non-core competency areas like technology development, marketing, et cetera? Do you feel like you have the resources in place to get where you want to go? Do you feel like the product is in a spot where you're satisfied? Can you just talk a little bit about that?
Yeah, yeah. Again, it goes back to structure, goes back to how far ahead of what you're trying to bring to market are you. Again, luckily, we've been actually rebuilding all three products for the last sort of 18 months with the vision of scalability, and obviously technology moves very quickly. So we've done strategic hires. We've brought on a head of product that was over all the product teams for all scripts. He's been an incredible, and we've been building out a team under him, essentially with the view of technology is the connective tissue, even though compliance and operations is the moat. So we've been basically really focused on that. It's one thing talking about the opportunity, the amount of businesses, but you have to execute, right? And you need a team to be able to execute. So building out the infrastructure was key on the software side. Now, to the marketing side, one of the things we noticed earlier when I talked about three different types of category of customers, some of the newer players that wanted to just get into this space, one of the things that they had a challenge with was marketing. So whilst they had a big marketing budget and they wanted to get into the direct to consumer space, during the onboarding process, they started to struggle with marketing. So we actually pivoted into hiring one of the former management teams on Teledoc, and we started building out essentially an in-house agency, for lack of a better word. So where we have a marketing resource for that category of customers. So of course we have different types of customers on the third vertical. As I said, we have the people that have already figured it out and we're simply migrating orders. We have people that want to get into the space, and we kind of bridge that gap with marketing. We also have a couple of accelerators coming on the other two verticals, which I won't go into. We can flesh on it on another. So the marketing arm was about to become very important for the overall thing. So we've been building that out with a view, of a kind of joining the three verticals together from a marketing perspective.
Okay, excellent. That's helpful as well. And then I'll maybe ask one or two more and then pass it along to Charles. So I like businesses that are sort of need to have versus nice to have, as you mentioned a few times. And there's a few elements of your business where you can really suss out the value prop being very high to your customers and to your users. And I'm just wondering, this is a heavily regulated industry. We've seen maybe issues with like a nationwide pharmacy networks, and at a high level, I'm just wondering how you think about maybe stroke of the pen risk, or if you have any mitigants in place to like unfavorable regulation, which I'll admit is unpredictable, but just curious how you think about that.
Yeah, we actually, that's our largest spend. We watch the legislation all the time. The interesting thing about what we've created is the ecosystem is in three different verticals, as I've said many times. Mobile health and wellness is treated very different than direct to consumer healthcare. The bricks and mortars then obviously have a different regulation. So we actually watch three different areas. The biggest risk is just it's highly regulated. Bringing out any legislation that is that is not what we've noticed with the boards as we were building out our first vertical is the people making the decisions at certain cases are not in touch with the actual what's actually happening, right? So we've had a number of scenarios. I'll just give you a couple of examples. The governor of Louisiana was one of our customers at one time with our nursing. A legislation came out that was kind of silly. To be perfectly honest, it would have caused a lot of complexities for the bricks and mortars and the nurses in that state that really were, unnecessary. So we actually utilized that connection to put us on with the medical board. We had that guidance reversed from a board level, and they also made Hydreight the gold standard of mobile health and wellness in that state. So that kind of offensive communication. We've never been trying to go around boards. We've been trying to go through boards since 2018, since our proof of concept. So being aware, I think once the boards are in touch with what's happening, and to be honest, the biggest change for me in the direct-to-consumer side is not so much the fact that industry is exploding. That industry was always going to explode. It's the fact that the awareness is now there for the customers. I read a poll, it's probably 2 months ago now, where 50% of the United States would like to try a GLP-1. There is no chance that 2 years ago anybody knew what a GLP-1 was, right? And that's one product that just falls into that category. So, legislation is always going to be one of the things you have to watch. But we want to be in addition to the movement. We're not trying to replace healthcare. We're trying to be in addition to it.
Okay, excellent. Thanks. Last
Mhm.
one from me, and then I'll pass it to Charles. So on the VSDH1 side, you're expecting kind of an inflection moving forward. It's grown nicely historically has grown at a nice pace. What do you think the biggest bottlenecks there are, and how do you kind of work through that as you scale the business?
Yeah. Again, that third vertical is super exciting, and rightfully so. The offering is very attractive to multiple areas of business, as I said, multiple categories of business in various stages. The one thing I think we've learned from the migration process this year is that moving a lot of the bigger players, if I go category by category, a lot of the bigger players who are simply moving orders to us to expand or further kind of secure their compliance or just utilize the pharmacy aspect. They like to go SKU by SKU, product by product, right? So they're already successful. So migrating a patient is not just simply moving from one software to another. You're moving to a new medical platform. There's a new medical director, new doctor network. The pharmaceutical itself can be coming from a different pharmacy in many cases. And there's different dosages on some of these self-administered. So in a GLP-1, for example, there's up to 6 doses. So what month that patient can be on is very complex, and trying to do it all in one go is not logical. So moving per SKU and per product and very, very low footprint and very strategic has been kind of the one thing that we learned in this process. It wasn't that we didn't think it would work like that. We just it was very, very important. The importance of it was actually was actually kind of shocking to us. So it's actually really good that that has all moved, executed really, really well. And that's why the inflection is kind of Q3, Q4 into next year. So I think that was probably the biggest thing that we had to watch from a company perspective.
Okay, excellent. And sorry, I'll sneak one more in there just to piggyback on your comments. So
Yeah.
it sounds like you're fairly confident, comfortable with 2026 order volume targets, forecast. And if so, do you expect to kind of release that publicly?
Oh, absolutely. Yeah. As a company, I think as historically, I think we've been quite open as much as we can be in the public setting with what we're doing. So yeah, there's always the kind of want from the company to share data and to share specifics into 2026. A lot of the time when we've spoken about businesses that we've had, licenses that we've onboarded kind of in Q1 of last year, been onboarding. And those guidance are from orders that were already in that ecosystem, right? We haven't really talked about what has been coming since then, right? Now, we have been, as a company, very, very focused on making sure that those businesses were onboarded correctly, and we had no hiccups, because obviously that's the kind of structure of that third vertical. But we have a lot of exciting things to announce from what has happened in the last couple of quarters, the attraction to the vertical, and how 2026 looks. And we will be sharing a lot of that.
All right, excellent. Thank you. I will pass it on to Charles, and then we will take some questions from the audience. Charles, the floor is yours.
Thank you, Adam. Shane, I want to keep going off this regulatory stuff because it's the number one question I get asked from investors. And the question usually goes around the FDA and the compounded GLP-1s. Everyone basically asks me if the FDA is somehow going to ban or limit the compounding of GLP-1s at some point. So I'm kind of wondering how you think about that risk and what Hydreight's doing to protect itself in that unlikely scenario, I think.
Yeah. So there's a couple of layers to that, Charles, and it's a very valid question. I would go in a couple of layers. We are a B2B direct-to-consumer business model where we're an ecosystem for the direct-to-consumer healthcare industry. So we're not pigeonholed as a GLP-1 business. The businesses that are solely structured to sell GLP-1s, and that's all they do and that's all they have done, absolutely, I would be, they have to be looking at all types of legislation. We are in a unique space where, because of our layered network, because we're a medical direction pharmacy network, we actually get kind of privy information as well. But we have over 43 treatments on our direct-to-consumer. Our goal is to be the home where these services are done. So we're not agnostic to the GLP-1, but we're much, much lesser risk than any other business, because again, that's not our business model. The addressable market is so huge in the direct-to-consumer market that's our focus. We have 43. We're going to have 75 most likely by the second the half of next year, and probably 100 treatments on just that vertical with the explosion of peptides and things like that. People forget one thing. And I am going to give a very specific answer in a second. I'm just giving kind of a holistic view here. GLP-1 is a peptide. It's a peptide that they kind of fell upon because of diabetes and the weight loss effect of it. But the explosion of peptides is now. I've been talking about peptides for 2 years, and that it's the new coffee in the healthcare industry, and this explosion. Somorelin is a peptide I talk about, which has essentially the same weight loss effect, plus other benefits, plus less side effects. So the GLP-1, of course, because it went absolutely crazy from the Ozempic and then the compound and then the shortage and all of that stuff, that's going to have a lot of volatility to it, right? If you see in the news, Donald is forcing big pharma to come down on their prices. It's mainly around insurance and Medicaid and Medicare. But as of right now, the way the GLP-1 is set up is that if there's a medical necessity, on the 503A side, a prescription can be produced and the compounded version can be given. That is not going to change from anything that we see, right? Now, if the FDA come in and say that this drug is banned, I would be very, very shocked because of the healthcare benefits to it. I haven't seen any indication to that, to be perfectly honest. It's all based around the flow, the medical necessity, the prescription, and is it coming out of a 503A for that specific patient? What they really shut down was the mass production of those, shipping it to bricks and mortar and doing 50 people with the same vial and things like that.
Yeah, thank you for that. And to follow up, I have a couple follow-up questions. So can you also talk about the litigation risk? Because Eli and Novo have gone ahead and they've sued a lot of these direct-to-consumer companies like Mochi Health and Zelfie and a couple of compounders. And I think they've described as the personalized medicine as mass compounding in the guise of personalization. So do you think Hydreight has any risk of litigation from all of this going on, and how do you kind of think about that?
Yeah, so most of the time, those lawsuits essentially are around marketing. Most of the time, if you really dig into it, it's not necessarily around the drug so much as it's around the marketing of the drug and the patent infringement. So that's kind of the high level that most people don't know. Hydreight is actually a layer separate from that. As I said, GLP-1, we're not selling GLP-1. we're bringing businesses to a platform, and if their patients are providing, we're the medical network, basically facilitating that prescription, right? So we're actually not marketing any of the drugs, even the 43 treatments on our third vertical. We're not actually marketing those. Now, again, the only one that has any sort of marketing connotation is the GLP-1, and that's purely around the patent. Now, remember, we have three different administration types of GLP-1 on our platform. The sublingual, which is obviously not the injection type, is one. There's a patch as well that goes on, and there's no patent on those. We also have liraglutide on there, which has been around for 15 years. And as I said, the space, it kind of gets caught up in this one conversation around GLP-1, which is really around semaglutide and tirzepatide and the injectionable version of it. It doesn't actually look at the peptide. So Hydreight's a layer removed from that. If somebody was going to be sued by big pharma, it would be the people marketing, and then it would obviously drip down to the pharmacy themselves. Which would only be the B, really. In the A case, as long as there's a medical necessity, you're absolutely fine.
Yeah, no, I appreciate that.
Yeah.
Also, you already mentioned this already. There's been talks about the Trump administration bringing the prices down for the brand names to possibly $149 for the lowest dosage. I mean, how do you think that may affect your business and your licensees as well?
Yeah, I think the GLP-1 is going to be very volatile for a while. I think Donald's President Trump, should I say, I think his goal is a little different. He is going after them to kind of make it lower cost for Medicaid, Medicare, and the insurance side of things. Because if you look at it, the other model already exists. So Roman, for example, have a membership model which gets you down to about $500 a month for the patented version, right? So, but it's a membership model where you have to pay additional services. So it's still extremely expensive, but it is about half the price of what it was, right? It was about $1,200-1,400, I think, for the thing. So there's going to be volatility for sure in the GLP-1. What I try to bring everybody's attention back to is it's a peptide. It's one peptide. It's a weight loss peptide. The explosion of peptides are everywhere. We are inundated by not only the businesses that want to come on to VSTH1, but businesses that want to specifically talk to us about peptides, right? And obviously that's an emerging space as well. The FDA are still, only approving certain ones, and you have to be on top of your legislation. You have to have a certain type of structure to be able to offer peptides again, which is one of our moats. But right now, to give kind of an overview, the GLP-1 compounding space is fine as long as there is a medical necessity. It's still really good value. And again, these patients that are already on the wheel, so to speak, it's a recurring medication. It takes a lot for them to come off of that because of a patent and start paying 3 and 4 times the price. And a lot of these things take time, Charles, as well. I think by the time anything maybe comes of the patent being available for a cash pay of very cheap, there'll be a number of peptides that have not got patent issues by then that do exactly the same thing.
Gotcha. Okay. And so you have a first mover advantage with your VSTH1 vertical, but since you've kind of started, have you had any competitors pop up with a similar model?
And no, so there's no direct comparison, even from our nurses. There's no direct comparison because the 50-state medical company concept is so incredibly difficult to structure that, from a compliance perspective, from a state board perspective, not only from a tech perspective, because even each service can be seen differently in each state. So you take testosterone, for example. Testosterone, which essentially you'd never come off test, it's actually, the flow of the service is different in Massachusetts than it is in Florida. So there's an incredibly complex there. So Of course, each layer has its own layer of competition, if you wanted to say that. But the way we're structured is we have telemedicine companies coming to us to want to plug in for the pharmacy management piece, right? So we're structured to be everybody's partner. We're not trying to be a competitor in anywhere. So if you took each layer and separated them out, you could say, oh, that's a competitor over here, that's a competitor. But from a comparison perspective, there has been no ecosystem for the direct-to-consumer market in the healthcare industry that essentially is a B2B to C model. There is none as of yet. And if I take the nurses as an example, we were first movers in 2019. We're still the only show in town that allows nurses to basically monetize their credentials. So there's a layer of complexity to this, but there's also a time component. Putting money into copying our third vertical, it would not be just the only challenge you'd have. You'd have a significant amount of time because of obviously how the medical network needs to be structured across all 50 states.
Got it. And so most investors are aware of the 1.3 million order goal, with 400,000 of those orders coming in December, which bodes very well for 2026. And it's my understanding that most of the costs for VSDH1 are already built in that cost of service you're charging to your licensees. So I'm kind of wondering with the operating expense of your business, because a lot of investors, I think, are assuming that those operating expenses should increase too much as this scales. But I mean, where could we see some investment? Where could we see operating expenses increase, if not all?
Yeah. So our operating expenses in 2026 will actually be very similar to 2025. And I'll tell you why. Not only are we, to my earlier point of we structured the departments and we structured the tech for scalability, we're going to bring in some key, management level personnel. We already have been doing that, building out our marketing, building out our tech division from a management perspective. And of course, we're going to need a few more bodies from the ordering perspective, but it's not in a relation to, as we scale every 100,000 orders, we need another person. We've been ahead of that. Two things are going to actually come down on our so our tech cost, which has been quite aggressive for the last 18 months because we had to bring this to market, will be significantly less in 2026, and that will kind of marry with the addition of a few management people. So our cost is not going to increase dramatically, if at all, our overall operating cost. We do have accelerators coming on the other two verticals, so there will be some cost there to kind of really roll those out aggressively. But as an overall, it'll be kind of par for 2025, even though the expansion will be aggressive.
Okay. And are you still, because earlier this year, Hydreight said it was planning to possibly make some investments in direct-to-consumer companies, take an investment and then move them onto the VSDH1 platform. Is that still something you guys are looking to do?
We're always open to opportunities. One of the reasons that mantra has kind of not come to fruition is the offering is so great on VSDH1. There's almost no need to invest, if that makes sense. Also, we didn't want to be seen as favoring one or two businesses. We want to be that ecosystem. It's the same reason that we don't just market ourselves, right? Why don't we just spend $1 million a month on marketing like other companies and just add services to the ecosystem? We don't do it because we have a bigger plan, right? We want to have 10,000 mini direct-to-consumer businesses instead of just being another player. What we are looking at, however, which is very, very explosive for the platform going into 2026, is we are speaking to a number of technical companies right now who offer the kind of employer payer side of things. So from the doctor network, so think of unions with hundreds of thousands of workers across the country. Think of employers, some of the largest employers. Think of ACOs. ACOs are essentially a collection of doctors. So they can accept remuneration, whereas a doctor him or herself cannot. So large groups of organizations that are utilizing a piece of software for their users. we can be the direct-to-consumer arm of that. So rather than the over-the-counter drugs that would normally be falling into that program, we're very excited about those. There's a number of those going on right now, which would essentially be a funnel of ongoing patients all of the time because of the contract relationship there. So investment into those type of technologies that are a plug-in to the third vertical is something that we're looking at and very excited about. And that only adds to the ecosystem. We're actually not competing with any of the businesses on there. And then obviously vertical integration on the pharmacy side is huge, because one of the organic things that we've been aware of since Q1 of this year, as we're looking at the ecosystem of orders that we were currently even looking at, is product supply. Okay, so product supply, increase the profit margin, of course, but product supply, control of the product, being reactive ahead of time if there's any change in legislation, those types of things. So we're speaking to a number of companies. Of course, we just previously announced an LOI, binding LOI with Perfect Scripts, which is a 50-state compounding pharmacy, 50-state 503A, should I say. So yeah, we're looking at a number of things on the pharmacy and lab space.
And I'll kind of ask this one because I think there's a lot of this in the Q&A. The average order value, I mean, the plan, it seems, is to get it to $40 CAD by the end of the year. So it's a little bit lower than that. And then in 2026, you seem to want to get that higher. Can you kind of talk about why it's that amount now and how you expect it to increase, just so there's understanding?
So yeah, it's actually really, really simple. There's three layers to it. So the price of medication as this direct-to-consumer kind of model exploded, right? Again, we're at the forefront of this. The price of medication has come down dramatically. So the cost of a GLP-1 to a client in Q4 of last year and the cost to them now from a pharmacy perspective is dramatically lower. So that was the first kind of thing. Then obviously in migration and customer acquisition for VSDH1, we wanted to be super aggressive. So giving some discounts for the lowest level SKU was an intelligent way to do this. Why the lowest level SKU? Because there's about 6 different dosages in the GLP-1s. Also, the other medications, the peptides, the testosterones, they increase in dosage as well. So giving kind of an aggressive discount on the first line was the easiest way to migrate. It was the easiest way to bring people onto the platform. Now, as the dosages go up, the cost of that medication goes up. So what you'll see is kind of an organic, not only increase of the overall cost of the service, but the increase of the profit margin, because that discount is not on the subsequent SKUs.
Got it. I'll ask one more and then I'll leave some time for the Q&A, the audience questions. I mean, Shane, 2025 looks like it's going to be big. 2026 looks like it's going to be a lot bigger. I mean, where do you see this business being in, let's say, 3 years? What's your 3-year plan for this?
Yeah. So I kind of, Charles, when I sit in one-on-ones, and I probably wouldn't say this in a webinar so much, but the graph looks fantastic for the last few years, but the addressable market here is so large that realistically, we're not excited yet. Okay. VSDH1, people forget because we've been talking about it for a year, is a brand new vertical. The first revenue has only hit the balance sheets at the end of Q2, but basically Q3. The addressable market here is so massive. The first 2 verticals we don't even talk about. We got 2 accelerators coming. One is around a custom financing package for the nurses, which is unlike any other financing. It's pre-approved, works like a credit card. Essentially, it's a partnership with a very large credit organization, and it works like a credit card for the nurse, where they can get in. The $3,000 does not become a problem, and they can pay it maybe at the end of the year in a balloon payment when they're making money. The second vertical, we're bringing a physical point of sale in addition to our digital offering. There is no layers to it. There is no medical direction. There is no pharmacy network. There is no bolt-ons. There is no basically Hydreight Technologies as well. So that's going to give us the opportunity to capture a large part of that market. And we feel very, very excited about that. And then the downstream effect of all of those is the pharmacy orders, right? The third vertical, of course, is super exciting. But getting back to my point, the revenue from year on year has been exciting, but the addressable market is so huge, and there is no like for like from an ecosystem perspective. Nobody has attempted to be the ecosystem where healthcare is done, the front lines of a sort. So I feel like the next 3 years is really when it starts. 2025 is great. 2026 is looking very exciting, but really the next 3 years, grow to $1 billion valuation and then grow to $1 billion revenue company. That's the goal. Will some organic conversations happen around acquisitions in between that? I would imagine so. There's going to be a lot of eyes on us, a lot of attraction, but our goal is to increase profit, make the company extremely profitable, increase value for our shareholders. Very strategic acquisitions and partnerships around the pharmacy space, but around the funnel space that I just talked about. Making some strategic partnerships with patient companies so that we can be the D2C arm, payers, people that have, they're providing a service in a non-competing way. That would be our focus, over the next couple of years.
Awesome. All right, Adam.
Thank you very much, Charles. That was great. Really appreciate it, Shane. Let's take a couple questions from the audience and then we can wrap up. So apologies if any of these are repetitive, but did you disclose at some point whether you're planning to share revenue broken down by each vertical?
Yeah, I did. In the previous questions, I don't think I did, but it is our goal to share revenue on each vertical for sure. Obviously, we haven't released Q3 yet. We want to give some guidance by the end of the year. Obviously, we know that Q4 and end of the year won't be till a few months into next year. So we want to definitely provide some guidance because a lot of what's happening here on the third vertical and the company as a whole, we should be very proud of. So we want to share that with the shareholders for sure.
Okay, great. And then a couple questions just about sort of the exit path. You mentioned a few months ago that you're confident that an exit is possible or probable within 12 months. How do you sort of balance that versus like the inflection of the business and the runway that you have in front of you?
Yeah, I think that might have been misconstrued. Whilst I feel there will be conversations had, approaches made in the next 12 months, it certainly would have to be an incredible deal, right? It would have to be reflective of where the company is going more so than where it is at this moment, because what we've built is so scalable. It really is an execution thing at this point. So we would, we definitely want to increase the we want to increase the value for every shareholder, of course. But if that opportunity is not big enough, it won't be considered, because the next 24 to 36 months is the part that should be exciting. What we've built here has been structural in many cases, and it's ready for growth. I've used the expression that we're still at ground zero because the market is just happening. So the awareness on the direct to consumer side from the public side was not there last year. Right, this movement that we saw, from the different industries, the movement towards the Uber and the DoorDash and the things like that, right? This movement in the healthcare side is just happening. And the expansion into preventative healthcare, individualized healthcare, where you get something to your home, you have some results come back to your app, you speak to a doctor and you have something come to your home. That's 360 healthcare. That truly is a preventative measure to the problems that the hospitals have, the problems that the greater ecosystem has. So that awareness has just started. So sure, we're going to be approached, but it's not the company's goal to be acquired in 2026. Yeah.
Okay, gotcha. Thanks for that clarification. Yeah. And then for VSDH1, in terms of the feedback you've gotten so far, can you talk about some of the positives and negatives that brands have given about the product?
Yeah. Negatives are real easy. I think it's mainly around the newer clients with the marketing, and the response we gave was obviously building an in-house structure to help them with marketing. Some of the behemoths which focus on just one or two products have kind of made the CAC, the cost of acquisition of a customer, kind of very high. So anyone who's looking to get into this space, of course, we solved that compliance measure and they're able to plug and play. But the marketing side was slower than expected for them. So we were able to kind of bring an in-house structure. So I think that was probably the number one challenge for one category of the customers. The positive side is what doesn't get talked about very often is that we're also an operational godsend to these people. Because we work on a widget, basically when somebody comes to that, the widget, we take it from there. So the doctor visit, the pharmacy order, the script, the dealing with the pharmacies, the payouts, it's almost a passive part after that for them. So them being able to focus on customer acquisition, focus on their company, what they want to do, their brand, and not have to worry about the operations has been, incredibly well received.
And then there's some questions that we got about just license growth. So I guess we can just talk about your expectations for maybe 2026. And you've talked about a line of sight to maybe 400 licenses and wanting to have 10,000. Do you have kind of a reasonable medium-term goal for license growth, and maybe and then you can talk about how average orders per license trends as you add new ones?
Yep. The goal is still exactly the same, and we're on track for that, which is 1,000 licenses by the end of this year. Excuse me. Next year, I see a kind of not exponential, but I see quite a growth curve there. We could be looking at maybe 2,500, 3,000 by the end. We obviously will be heavily focused on outbound sales in 2026. Remember, this has all been inbound traffic. Up until literally this quarter, we haven't had an outbound sales funnel, and we're only structuring it right now. So that hasn't had any effect, and it won't until most likely Q1. But next year, we look at maybe 25 to 3,000 licenses would be our goal. Past that, it's hard to give the data. The data sample size is not very high yet, right? We're still in kind of onboarding. Our goal is to have everybody onboarded of the existing licenses by the end of this year. We're continually improving our onboarding speed and process. There's some things that are outside of our control, which is like LegitScript, which is just a certain amount of time. We're enterprise level LegitScript, so that's another moat for these people because they would not get approved otherwise. Most of the questions are around your medical structure, not so much your brand, right? So they wouldn't be able to do this otherwise. But that has an organic, there's nothing we can do about that those weeks. So we've been kind of basically improving as we've been growing, as a company should. I'm excited to say, from an execution perspective, we haven't fallen on our face in any major way. We've noticed some trends, reacted, such as the marketing, and we'll continue to do so. So yeah, it's positive, and you've got to continue to execute.
That's helpful. In line with that, there is a question about what keeps you up at night, kind of in line with where do you see the business in 3 to 5 years? Can you just talk about biggest fears or concerns of yours?
Yeah, well, other than a micrometeor shower hitting the servers or something like that, would be just legislation, just keeping an eye on the legislation. I mean, as I said earlier with I believe it was Charles's question, we're a direct to consumer ecosystem. We're not beholden to one brand. Right. So, and the movement with the public has now happened. 2 years ago, you might have been beholden to one brand because that's all they knew, right? They just knew one direct to consumer thing. So just legislation, just continually keeping an eye. We're structured very well to do so. And again, it's not only a moat for businesses to come on, it's a protection mode for other businesses trying to get into that third vertical, because it really, really is difficult. So that's kind of it, just keeping an eye on the legislation of each of the three verticals. But we're structured to do so.
Perfect. And maybe we can just wrap up here. So working capital needs of the business, we did talk a little bit about this. As you scale, if you grow revenue to 500 million next year, how do you feel about short-term funding? And maybe just talk a little bit around, again, like barriers to scale.
Yeah, company's in a very strong position from a capital perspective. So have about 17 million cash, basically, from a capital market raise and a debenture. We're cash flow positive, and the goal of the company is obviously to increase that, become massively profitable from an organic perspective next year, and utilize the funds as we've communicated throughout the year to basically acquire, partner, and just scale the verticals at a much faster pace. Some of it will be around vertical integration and protectionary measures on the pharmacy side. Some of it will be purely around B2B partnerships to act as a funnel. So those will be our two main focuses.